we saw a company at demo day doing 50 million in profits at demo day. My bar is going higher where I'm looking at companies who've made more than 500K at demo day, more than 1 million at demo day. We invested in a YC company doing 2 million. The last two batches have broken the revenue record is because you can build so quickly. It's honestly the most impressive technical solution that I've seen in the last 3 years. I've never seen something like this ever. All right, we're back. Hello again. Welcome to the Lobster Talks podcast by Lobster Capital. We're talking today with Laurie again, and we're dissecting everything happening with AI, but most importantly, Winter 25 batch and Winter 25 demo day from Y Combinator, which happened just a few days ago. So let's just dive in. Laurie, thank you again for being here.
Yeah, cool. Good to be back. And we are getting used to the more frequent demo days with the full one finishing in December and then straight into the first batch of 4 this year. And this year is the most investments into a batch that Lobster has made as a fund. So that'd be a good place to start. Like what was so exciting about W25 and the companies that you've seen?
So yes, you're right. We've made our most investment, not by a lot, right? We usually do 2, 3 to 5 investments. With this one, we've made 4. It is a record, I think. So you're probably right. I think there's 2 elements. One, the batch was slightly bigger than the previous one. So the last one was fall and it was 95 startups, I think. This one was 166 with 160 presenting at demo day. So it is a slightly bigger batch. I think it's because it's one of the original batches. When there used to be 2, Winter used to be one of them. So people remember the date, the deadline, etc. So that's the first reason. But the other reason, to be honest, is I think the quality of the batch was quite high. If I'm not mistaken, it broke the record in terms of revenue and growth of any YC batch. And I believe the record was held by just the previous batch before that. We already had that conversation 3 months ago. We said it was the new record and it beat that record once again. So the quality was really good. They're back in person, back in San Francisco. I think we had transition years with Gary Tan coming back in 23, and they just changed a lot of things in the model, went to 4 batches, went back to in-person. Now that's it. It's working. It's full steam ahead. And obviously we have a lot of AI companies. We have a lot of companies using AI for coding. There's been talk about vibe coding. Hopefully we get back to that as well. So it was a very impressive batch, to be honest. And I'm only more excited about what's coming next.
Yeah, so it'd be good just to touch on maybe what you can and can't share then on those portfolio companies, like the sector that they're in, what makes them different. And then obviously within that, is it just the new norm that every startup now coming out of YC is somewhat AI focused? And is that the case for these 4?
Lobster focuses again on one simple thing, but it's not that simple, which is the top 2% of YC companies. And top 2%, what do I mean by that? I've talked about it in this podcast several times. It is top 2% in terms of early revenue and revenue growth, but also top 2% in terms of team and go-to-market strategies to be able to grow that revenue in somehow an automated way, automated fashion. And those 4 investments fall into the same bucket of very, very strong early revenue, very, very strong team. So we invested in a team of 2 Stanford dropouts. We've also invested in a company that's going after a huge market where the 2 founders were working at some of the biggest companies of that market right before. So they're really experts. They've actually done some breakthroughs at those companies that they're leaving now and taking to their new business. So we're really trying to focus on the top 2%. What's interesting, what I noticed is a few years back, there were very, very, very few companies who were breaking the 100K revenue mark. Most demo day revenue, most startups were 5K, 10K, MR. And if you're like at 20, 30K, it was exceptional. And the 100K and above were like 1, 2, 3 per batch. What I've noticed now is more than 100K, there's now maybe 50 in a batch of 160. So maybe a third are higher than 100K. This is just, I didn't do the math, but that's like top of my head. And so what's interesting is I don't want to invest in the top 30%, right? I want to invest in the top 2%. So I think my bar is going higher. My bar is shifting up where I'm looking at companies now who've made more than 500K at demo day, more than 1 million at demo day in summer 24. So 2 batches ago, We invested in a YC company doing 2 million in revenue at demo day. Given they started slightly before YC, right? So they have a little bit of a head start, but still, 2 million in less than a year, still very, very impressive. So in this batch, we kept the same idea. We have a company that's doing 1 million already in revenue. Some others are between the 100K and the million range, but that's, I believe, good news for everyone. And again, I'm not being content with just 100K. If the bar goes higher, then Lobster Capital's bar is going to go higher as well.
Yeah. And so I'd be interested on that revenue stat just to hear how you're thinking. And I think we touched on this a little bit before, but maybe just especially as the revenue kind of expectations do keep growing within YC, there is this kind of shift now that's happening where people are testing a lot of new products, especially in AI. They see like a demo and think they want to try it, so they'll sign up, pay $20, and maybe that's happening across a lot of users. And so in a short batch or a short time frame, like where are the real markers that you're looking at for how to assess revenue that is beyond vanity metrics? Is that in retention? Is that in customer feedback? Like what is it there that kind of qualifies that revenue?
Yeah, you're absolutely right. There's revenue is revenue. I wouldn't say it's a vanity metric because revenue is the golden metrics, the king or the queen of them all.
Maybe in that scale up, like you hear, so companies will come through YC, they'll have done 3 months maybe of public posting, and then they're extrapolating out what an annual revenue might be.
Yeah, that's true as well. So that's part of my answer is, the number is the number, but then you look, is it actually monthly subscription and you've multiplied it by 12, or do people already pay for annual plan? So they have trust and faith that they're going to use this for the upcoming year. Churn, obviously, you mentioned it as well, is important. And usage. Some people just try it for a few days and then stop. Some people actually integrate their product into your business. If you have an API that's integrated into some people's workflow, then you're here to stay. You're here to stick. That's what made the fortune of Bill Gates and Microsoft. Once a company runs on Windows and then buys Microsoft Word, Microsoft Excel, blah, 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 then it's becoming exponentially harder and harder to rip everything off and start from scratch and go to either Mac or Linux or something. I don't want to answer your question by pretending that revenue is not important. It's a secondary metric and then we actually look at retention. No, it's not true. Revenue still is the main metric because customers vote with their credit cards. And even, you're right, you could be paying $20 for a tool and then canceling it. But if you really don't like the tool at all, or you don't think anything of the tool, you're not even going to pull out your credit card and pay the first $20. But that happened for us. The company that I mentioned that was doing 2 million that we invested in summer 24, so in early September last year when we invested, they were doing 4 million. And then they had a bunch of end of year promotions, Cyber Monday, Thanksgiving, Christmas, Black Friday, etc. A lot of promotions. And they ended up the year at 4 million. And that was insane, right? They went from 2 to 4. But actually, I can talk about the numbers because it's anonymous. I'm not naming them, but they've gone down now in the beginning of the year with high churn. I think they went from 4 to 3.5. And so two things. One, it's still much better than 2. But second, it is a problem. Churn is a real problem. And they know it. They're addressing it. They're looking into it. And they're looking at who are our best users and who are people just trying it and unsubscribing. And maybe those massive promotions are not a healthy way to grow the business. Or maybe they are just because you're going to retain some of it, but you have to expect a huge churn early on. So those companies, they're learning. Remember, if you're a YC company, odds are you're going to raise more than your average other seed round startup. So you have more money, more time to just iterate and keep learning. Revenue is still king or queen. Of course, there are other metrics. Do you integrate it in your business? What's the churn? Do you pay upfront? And usage. I was talking with a YC founder yesterday and he told me we don't do subscription. We only do usage based because we want to have real-time feedback month after month if we're actually growing in usage, which is smart. So if this works out, probably more and more YC companies are going to do the same.
Yeah, so it definitely seems like retention is an easier problem to fix than no traffic or no revenue, of course. Yeah.
Exactly. Yeah.
So obviously one of the things that you mentioned in there was around like the vibe coding thing, and there was obviously the headline quite provocative perhaps in TechCrunch last week around a quarter of YC startups have an entirely AI generated code base or more or less along those lines. I'm just kind of interested to hear obviously this is part of like this fast development cycle that we're getting used to, and YC is obviously pushing that from both how they encourage startups to build, and then also they're owning that from a narrative point of view, especially as it's probably going to lead to more revenue as companies can get software out the door faster. But just from your perspective, like obviously you gained your technical stripes in early 2000s when there was not so much of this happening, and like is technical debt going to become an issue? Like, yeah, sure, you can get an MVP out the door. You can then have incredible distribution over things like TikTok and Twitter. But over the long run, like, can you go and build a huge billion-dollar company with this technical debt creeping in?
No, I think you're right. So, I mean, first of all, YC, I think, has been giving the same advice for 20 years, right? YC just turned 20. Happy birthday. And it's like build and go talk to your users. And I think that's one of the main reasons why batch after batch, the last two batches have broken the revenue record, is because you can build so quickly. And so it used to be before, I remember vividly, even 3 years ago, where YC was 3 months, you would build for 2 months, and then only the last month you'd start selling and try to get revenue for demo day. And now you can build the first week or 2 weeks a prototype in a couple days, and then already start talking with your customers and keep improving. So this overall is great. It allows companies to build faster, iterate faster, and sell faster. And by the way, AI is helping them sell as well, where you have all those AI SDRs and AI tools allowing you to target your prospects more effectively, to find them online, to join the conversation, et cetera, right? So on both fronts, AI is helping, mostly on the building. Now, you asked me about technical debt. I mean, of course, AI is not putting every developer out of a job. It is a prototype. And what's interesting as well is YC did not start accepting non-technical teams. They could say, because we're doing vibe coding and we don't need to code, we'll just take anyone. That's not what they say. And I believe they're not going to change in the future. They're still taking some very technical people that can do some vibe coding, but that can also actually code themselves. And I agree. I think it's very unlikely that you scale to $1 billion or to tens of thousands of users without actually going back into the code and fixing some stuff or doing some stuff manually. I think it's very likely that you're going to have to do that. But that being said, it's like sort of two different problems. It's arguably harder to going from the 0 to 1 than from 1 to 10 and 10 to 100. Because once you reach a certain scale, you can hire some people who've done this before. And it's quite similar for everybody to go to 10 to 100, how you scale an organization. There's a lot of similarities. But going from 0 to 1, finding the first thing, the product market fit, that's the hardest part. And that's why most startups actually fail. Even at YC, there's more than 50% that fail in the first 3 years. So that's the hardest part. And I would say overall, it's a great thing, but it's not perfect. It's not everything. We're not done with developers, but it is an opportunity. And yeah, YC themselves during this batch, I think they said it was a good chunk. Was it 75% or something that had more than half of their code that they didn't write themselves?
95.
Oh, 90. Okay, yeah. So that's the thing. It's insane. And it's only going to grow and grow and grow as tools actually get better. AI was very good at doing the front end, but now there's a lot of tools doing the back end, the integrations, the databases. Actually, one of Lobster's investment in this batch is someone in this area. I won't go too specific here, but trying to go after this. And it's honestly the most impressive technical solution that I've seen in the last 3 years. I've never seen something like this ever. It's completely insane. We're at this tipping point now where it's really starting to get magical. There's this theory that innovation is indistinguishable from magic, right? If you go to the 1920s or the 100 years ago, and you show someone what we're doing right now, right? We're on Zoom or it's another podcast thing, but like we're talking, we're seeing each other, we're not at the same place, it's in real time. They would think this is magic. Like, what is this mirror sound thing, right? It's indistinguishable. And so with those AI models now, with the way they build tech for you, the way they code, it's getting close to that as well. And the investment that I made is this: you just have a few prompts and then something appears and it works perfectly from A to Z. And remember, it's also only the second batch, I think, that's using Cursor. Same thing. That's the vibe coding thing, right? It's empowering. So great thing overall. Imagine for the next 10, 20 batches, what tools they're going to have. It's so exciting, but it's not perfect. It's not going to remove technical debt. Actually, that's an idea for a YC company. An AI specializing in fixing technical debt for very fast growing and scaling startups. I believe we're going to see some of those companies in YC in the future. I think we actually saw one in the previous batch attacking a very similar problem.
I think Gary Tan said himself, like, this is not a fad, like it's not going to go away. And obviously, I think everyone's embracing that across the board, which is obviously exciting now for startups to ship quicker. Yeah.
I posted on LinkedIn last week, like, this is one of the most exciting times to build a business. And so sometimes I wish I was building a business now. I have better things to do. Some very exciting stuff happening at Lobster Capital and very cool things to look forward to as well. But I told myself, if all fails, if Lobster doesn't work out, which again, I don't see how it could not work out now. The Fund 1 is oversubscribed and Fund 2 is well on the way. Anyway, I don't see how, but I could just go back and be a founder, apply to YC and just build something. It's so exciting. It's never been like that. Or maybe it has in the 2000s with internet, but it is really exciting. I don't know how long it's going to last, but I think it's going to last several more years from now on, because it's already been two-ish, almost 3 years. And yeah, so it's such an exciting time.
Yeah, I wanted to go as well then on the AI agent space. Like, I think what seems to be happening, at least from a discursive perspective, is like this AI agent for X is increasingly this new way of phrasing things. We've gone through the Uber for X, the Airbnb for X, the Craigslist for X, etc. Like, now the new one is agents for X. And so there's kind of two parts to this question. So one is around your take on those startups. Potentially it's not as obvious what those will look like in 3 or 4 years' time. But then also around this idea of, I think there was this graph posted a few months ago by Rex Woodbury, who was saying, like, if you look at what the kind of hottest topic was from each year, and then where actually the biggest companies have come from, they never really feel that aligned. I wonder whether, like, how do you feel about that? The AI agent kind of tag, is this the right thing to be looking at as a pre-seed investor now, or is almost like the ship sailing there?
So I don't think the ship has sailed yet. I think it is moving very fast. I think it's the hot flavor du jour, right? But I think in most ways, rightfully so, because what it empowers is pretty massive and we haven't seen half of it yet. So you asked me, should investors be looking for that? Potentially, yes, with the big caveat and the big warning that almost everyone is doing this now. It's really the new thing. And so it's going to be super, super competitive. Most are not going to make it. That's startup investing for you anyway. And of course, investing in YC startups with Lobster Capital, we have an advantage. YC startups are better funded, better network, better selected, better founders. We've talked about this countless times. It struck me recently that I think my last 10 investments with Lobster Capital are companies that would not have been even possible 6 to 12 months before. And in the last batch, we invested in an agent that's helping consumers get money back. So what happens is when you buy something online and then the price goes down, according to almost every single policy, you're entitled to a refund. But most people just don't check every day. But if you buy a pair of Nike shoes, this agent is connected to your inbox, to your Gmail. So it knows, oh, Laurie just bought a pair of Nike shoes. And then it's going to monitor every day the Nike website until there's a promotion. So that's already an agent. Then it's going to read Nike's refund policy. That's another agent. And then it's actually going to, on your behalf, write to Nike's customer support and be like, hey, I'm Gabriel's AI agent. I noticed you just dropped the price on those nice shoes. According to your policy, Gabriel's entitled to a refund. Can you refund him? And so this agentic use, again, could not have existed just 12 months ago. It was not possible. So now the sort of the new thing that everyone now talks about, but it's the same, it's an agent, is AI coworkers. What it is, right? Agent is a fancy word that we need everyone else that's not in tech to understand, and we've got AI coworkers. So now if you look at companies in the entire world, even in the US, and if you think Europe, Asia, it's how many companies have AI coworkers today? 1%, maybe? It's extremely little, and that's for a very specific use case. use cases, but it's actually going to grow. The agents are going to get better. The use cases are going to grow a lot. So there's probably 5 years from today where you can sell agents to companies and make a killing because there's a lot of companies in the world. I heard somewhere that there's 20,000 companies in the world that make more than $1 billion in revenue. 20,000 companies. And each of those companies have thousands, if not tens of thousands of employees. And if you just replace 5% of just those 20,000 companies, like again, you have work for the next decade. It's never just black or just white. I think it is some sort of a trend because the opportunities are endless. I also believe it's a potential trap for investors because everybody wants to build there. So you really, again, that's where having people full time thinking about this, looking at companies is better for most investors than doing it themselves. I see so many people say, oh, I angel on the side. If you're just doing it on the side, I don't know how deep can you go. So I see the entire market, the entire YC market. I see the market aside of YC as well because it's my job and I only have this to do. Yeah, lots of potential. And like most things with such potential, lots of people who want to build in the space. So you have to separate the good from the bad. But I think it's probably not too late. I think it's probably actually the very beginning.
Yeah, I just wondered then on like even looking at those companies at the pre-seed level, do you sometimes feel like it's worth waiting, seeing what happens? Like, is that a smarter strategy for pre-seed? Like, Facebook is not the first social media company, the kind of things that people always throw around there. And so, specifically thinking about YC, is it actually, does value then going to come in a few batches' time? Or is it worth really doubling down on the earliest versions of these AI agents? Because obviously, if Lobster's thinking about, you need to be thinking about batch 2033. How do you think about?
Two things. First of all, I don't consider myself a pre-seed investor. I consider myself a seed investor, late seed, because it's seed with strong growth, traction, and revenue. And I'm happy to pay a slightly more expensive price, but to have lower risk because it's de-risked with strong revenue and growth and traction. So for sure, at pre-seed, I think it's worthwhile to wait just because let's wait until there's proof in the market that they can actually sell. Okay, so that's one thing. On the other part of your question, maybe everything I've invested in so far is going to go to zero. Maybe it's the 99 to 2001. And actually the 2001 is going to happen. And then you only make money on what you invest after. That's possible. And that's something that keeps me up at night where, what if we have AGI in 3 years? We could have 90% of the startups going to zero. That's possible. That being said, the fact that it's possible doesn't mean, in my opinion, that you should be in the sideline and not invest. It's pretty much like in the stock market. You hear all those people saying, oh, I'm not investing now because the bubble's going to pop. It's going to be lower in a few years. And those people end up never investing because every 2 years, oh, I'm going to wait some more. I'm going to wait some more. And then 20 years later, they're still waiting. They haven't invested. And you've invested along the way in the stock market. And maybe you had a few crashes along the way, but overall, you've made a lot of money. People say time in the market versus timing the market. I believe it's the same here. There's a possibility that some of those players are too early. Some of those investments will be too early. There's a possibility that AI changes so much. And by the way, I'm trying to stay away from startups and tools where it's obvious that they're going to be irrelevant in 2 years. We've talked about this as well before. Sometimes it's obvious it's going to be irrelevant in the future. And so this I try not to touch. But for the rest, I think you still have to take the bet. And of course, you're taking a bet into the unknown. Sometimes you don't know. Nobody knows what the world is going to be in 2030. In 5 years, that investment will look stupid. How could we think that this company was going to make it where today we have ChatGPT 6, ChatGPT 8 or something, right? But at the time that I'm making the investment, I'm thinking it has potential and it can withstand the test of time. And I think it's better to stay investing. Otherwise, you never invest. And by the way, I also think I think, talked about this. I think we're at peak illiquidity and peak slow exit time. I think exit time is going to reduce a lot in the future. And if that's the case, you could also invest in a company now and exit in 4 years before the world changes. And that's another potential upside that I see. The question is fair, and I think you're right. The world is changing very quickly and it is dangerous for them. At the same time, I don't think you have any other choice than to keep investing.
Yeah, makes sense for sure. I think one of the things you obviously touched on there is like paying that slight premium think we've slowly been seeing that creep up a lot. And obviously, this batch had the highest ever valued YC company at 100 mil. I think there was another in the batch somewhere around 60 mil. And obviously, we've seen that quite consistently with this like AI apps run up, like Perplexity, I think, raised at 180x valuation multiple, Hugging Face somewhere around 90x, and actually even Sierra, I think, was close to 200x revenue multiple. And obviously, those numbers are slightly out because there's a little bit of like brand affinity attached, especially to things like Hugging Face and Perplexity. But maybe even in the YC, the valuation of the company at 100 mil, assumedly, is not that far off a 50 to 100x multiple. So how are you seeing that, and how do you think about that?
That was more than 100x on the revenue. So first of all, it's not. I don't think it's an absolute record because I've seen 100 million before, but it's like really pre-COVID or ZERP era, like 21, 22. We had crazy prices. Since ZERP, I never saw 100 million ever again, and this time we saw it. So I think the AI bubble is growing, is expanding. Right. That's one thing. Second thing, my first reaction when I heard 100 million was it actually depends what you're buying. If it's a company doing 10 million in revenue, started a year ago and doing 0 to 10 million in a year, and you buy it at 100 million, that's cheap, right? So depends what you're buying. Turns out they had what I would say very small revenue. I won't share. It was way beyond 100x. So it means they had way below a million in revenue. And so I did think it was crazy, but they raised, and actually they raised, if I'm not mistaken, 15 million. So it might have been one of the biggest amount raised, whatever the valuation, by YC. Oh no, that's not true because StarCloud raised 21 million last batch. Anyway, it's up there. I think the potential AI bubble is coming back. The revenue was very small. I don't know what warranted this valuation. My job is also to be looking for reasonable valuation. So again, I'm not against paying a slight premium. If you think it's going to be a unicorn or even a decacorn, because remember, 25% of YC unicorns actually become decacorns, and you wanted to invest at 20 million valuation, it's actually 25 or 30. My opinion is you do yourself a service to actually get into that company, and maybe instead of doing a 500x, you do a 400x, but that's still great anyway. So that's my view on it, but it has a limit. If it's 100 million, first of all, if it becomes a unicorn, which is very difficult, it's only a 10x. And it has a lot of other problems. You need to grow into that valuation for your next round. A lot of times, a founder getting too much money is a curse because you're spending too much and you don't know how to grow without the money. So they just raise 15. I'm not sure they're going to make it. I hope they will, but I'm not sure. And on the other hand, we saw in YC, and I think this one was a first, we saw a company at demo day doing 50 million in profits. At demo day, 50 million in profits, which I'm not sure they even raised. They don't need to with 50 millions in profit. And again, this probably, I'm not sure, but this probably wouldn't have been possible without AI just a few years back. So that's pretty exciting. Maybe we're going to see more and more of those. Company doing 5, 10, 50 was the number this time, million in revenue or even in profit. That's pretty insane, honestly.
And I guess like with maybe some of those increased valuations as well, is now thinking about where those exits come from maybe earlier. Is there a scope or increase that you're seeing maybe with companies that you've invested in a while ago where more founders are looking at trying to position themselves strategically into acquisition-based exits, or is it still with this big IPO push that I see companies typically talk about?
No, I think it's both. So most YC founders don't build to exit. You build to build a great business, make something people want, and create value. I think founders realize that an acquisition is much more likely than an IPO overall. And it's true. If you look at the numbers, there's at least 5 times more acquisitions than IPO. I think they know that not everybody is going to IPO, but you can also have an amazing outcome with just an exit, right? Being acquired for 500 million, a billion, 2, 3, 4, 5 billion, 10 billion is an amazing outcome. Regardless, some would say it's even better because you don't have all of the headache of the IPO, of the SEC, of the filings, of the compliance. You just get acquired. And what's interesting is you have a lot of companies that can very easily acquire you for 1 to 10 billion. They have the pockets for it. Where in Europe, That's one of the reasons that I moved out of investing in Europe 5-6 years ago now, because in Europe, no one can acquire you for 10 billion. That doesn't exist. That's one thing. The other thing I want to say is, yes, there's been an uptake in activity at the end of 24 and beginning of 25. But to be fair, to take the other side, first of all, it wasn't hard to have more activity than before, because 23 and 4, we had nothing. It was zero. Also, I've seen now in the last month, I think end of February, March, at the time we're taping this, right, mid-March, there's more uncertainty apparently in the markets as well, right? The markets have been very hesitant, and there's the whole question with Ukraine and Trump and blah, blah, blah. So we don't really know what's going to happen in the next 9 months. And so I think people are a little bit more hesitating right now. Maybe it's just a blip. I strongly believed that 2025 was going to be a very positive year for venture with a lot of exits, a lot of investments, etc. March has slowed down. Let's see, right? I don't want to do a day by day, week by week, month, because I don't know, and that's not my role. But it has been overall, compared to 23 and 4, it has been accelerating. And I personally think, or thought up until now, that it still had room to accelerate even more. I think we're not back into full speed, full steam ahead. So let's see how it develops. I don't know, but it's good that we have something. We don't have zero activity. And many of those companies, it's interesting. My portfolio, I was very fortunate that they didn't raise for 2-3 years, more than usual. They went into cockroach mode, survival. But some of them were just, we're going to be profitable and we're going to grow. And some of them have grown tremendously. Many companies that were doing a couple 100,000 in 22, 23, and now are getting close to 10 million, or from between 10 and 30 million. Those really start to become prime target for acquisitions. And if they keep going, in just a few years, they can close in at 100 million revenue if they keep it up. And now you really become an amazing, juicy target, either for an acquisition or for an IPO, for that matter. At 100 million, it could be a small IPO. That's what matters. It matters that they're building, they're growing, they're profitable, they don't have any difficulties running and growing their business. I'm a very patient investor. If they take 5 more years to be acquired, it means they're acquired for hopefully a higher price. I'll be very happy. If they're acquired in the next 12 months, I'll be happy for them regardless.
And just on, I think let's do the last question. I think this would be interesting to get your take on this. Having met now all the founders through Demo Day, just building on what you're saying about YC founders are not thinking about exits, they're building for the long run. One of the things that we've seen, or at least articled in the last few weeks, has been around this kind of vibe shift with founders wanting to raise VC less. Like, when you talk to founders, have you noticed that? And obviously I think it's slightly narrative, because I think there was $250 million deployed on Demo Day, so it's not necessarily true.
There is some truth to it, but I don't feel that at all. So first of all, when you're a YC company at Demo Day, you're in a very unique position that I think doesn't happen anywhere else in the world ever. Is you can just raise your hand, scoop some money from the floor, and you can raise several millions of dollars in a matter of days, if not hours. So that's so unique. And I'm pretty sure YC says you should take advantage of that opportunity because it is a unique point in time. What I have seen, and I think YC says this as well, is if you raise, great. But if you don't raise, that's also okay. And I see some companies that they're usually targeting to raise 2 million, let's say, but some companies that just raise 1 million or 500,000 or 1.2, 1.3, something like that. And what YC says is, don't waste 3 months chasing investors for a couple hundred. Just fundraise for 2 weeks after Demo Day, and then whatever the amount, you call it a day and you go back to building. And the YC founder that I was talking with yesterday, they did YC in 23, they just raised 600K and they've been profitable building. But now finally, after 2 years or a year and a half, they have product market fit and they have traction and they have growth. And so now they're raising 2 and 20, but a year and a half later. So that, I believe, is true. And that's maybe where you might hear we don't want VC money. Again, it's a simplification. It's like, if it's super easy, we'll take it. If it's not a big deal, because we can just keep growing. So that's, I think, the two realities that I see. But it's not, like you said, there's 250 million that changes hands in a matter of a few days. So it's not like, oh, YC doesn't want VCs anymore. YC needs the VCs and the companies need the VCs as well. There's very few billion-dollar companies, and for that matter, decacorns, so $10 billion companies that have been built without any fundraising. I don't know if it ever existed. If it does, it's extremely rare. So, VCs still have a role to play, but that's, I think, the thing to remember is sometimes for YC companies out there who haven't raised, it's not a big deal. And there's many other YC companies that proved it in the past.
Okay, that's a good place to leave it.
That's a good place to end. Thank you so much, Laurie. I had a blast. Thank you to our lovely listeners. If you're on YouTube, you could watch us. Please subscribe for our next episode. If you're on your favorite podcast app, please leave us a 5-star review. Until next time, see you. Thank you. Bye.